Well, good afternoon, ladies and gentlemen. Well, good afternoon to those of you joining me here on the East Coast. Good morning to those of you who are in the Central or the Mountain or the Pacific time zones. And, of course, good evening if any of you are joining us from across the pond in parts of UK or parts of Europe. And good early morning if you're joining us from Australia or parts of Asia. Welcome to today's presentation, part of our Options Investing Concepts series. Today we're going to take a look at implied volatility, what we refer to as the double-edged sword for options investing. Now, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. PowerOptions, of course, is a subscription service. It's a patented suite of tools for options investors. We do support over 23 of the most commonly used options strategies and tools, of course, to evaluate other strategies as well, custom spreads, for example. Our tools allow you to search across the universe of options to identify positions that match your options criteria and stock criteria. And we also have tools to help you track, manage, and adjust those positions quickly and effectively as well. We also, of course, have various help videos, tutorials, and archive webinars on using the PowerOptions tools and the various strategies as well. I want to encourage everyone, when you logged onto the webinar, the GoToMeeting, GoToWebinar platform appeared on your screen. If you have questions at any time during the presentation, just use the question pod there inside the GoToWebinar pod to send us a question, and we'll take a look at that from time to time, and we'll also prompt you throughout the presentation to see if you do have any questions coming up as well. And for those of you that are curious, PowerOptions, we have been in business for 17 years. Ernie Zarena created the PowerOptions tools back in '97, and of course we made several enhancements and adjustments to those tools over the last 17 years as well. Well, for today's presentation, what we're going to do is discuss an introduction to implied volatility. We're going to keep it in common terms. We're not going to go in-depth into various equations and advanced math as well. We're going to talk a little bit about comparisons of implied volatility, how they affect your options price, and what kind of numbers you might expect for different positions. First question came in here. Bill said, we'll need to leave it before the end of the video recording. Of course, we are recording this presentation, and it will be available in the webinar archives, and I'll show you where to access that later on in the presentation. After we take a look at that, we're going to discuss a little bit about evaluating the implied volatility, what investors look for, and what do we mean by the double-edged sword. And then we're going to take a look at the PowerOptions tools to help us see which tools we can use for helping us evaluate and screening for, of course, different implied volatilities and what you'd want to look for as well. Well, many of you have probably heard a variety of different definitions and terminology for implied volatility. Now, some of these basic ones that you may have seen. Implied volatility is the value that justifies why the option is not priced at its theoretical value. You may also have heard implied volatility described as how much the option is over or undervalued. Implied volatility is sometimes defined as the risk of the option, the measure of risk of the option. And another definition that we see is that the implied volatility is the forward-looking measure of where the market expects the stock volatility to change to within an upcoming time frame. Okay, so these are some of the definitions that you've probably heard, and all of them are correct, but of course some come with a but. Now, how much the option is overvalued or undervalued? Does implied volatility really reflect that? Not by itself, only of course compared to other measurements that we use. The risk of an option, well, yes, if we see something that has a higher implied volatility or implied volatility out of the norm, that usually points to a future event that could cause a swing in the stock price. It's not a guarantee that that's going to have an effect on the option or the underlying security, but it is a forward-looking measure of risk. And then, of course, we look at the forward-looking measure of where the stock's volatility is likely to be. Well, that's true, depending on the event, the outcome of the event, and if the event does occur, and we'll go deeper into that a little bit later on. In simplest terms, what we're going to look at implied volatility as today is the value that justifies why the option is not priced at its theoretical value. And this means what exactly? Well, the theoretical value of an option, where the option should be priced, pricing models such as the Black-Scholes are usually used to determine where our options should be valued at. And the Black-Scholes pricing model takes into account 5 factors. your underlying stock price, the strike price of the option in relation to the underlying stock price, the days remaining to expiration, the volatility, typically the historical volatility of the underlying stock, and occasionally different time frames are used, and then of course the risk-free interest rates as well. In addition to that, dividends will, if the stock pays a dividend or doesn't pay a dividend, and the amount of the dividend will also come into effect as well for the value of the option. As options traders, we focus on three types of volatility, three different volatility forms. Historical volatility, HV, is related to the stock. And historical volatility is the measure of the stock movement over a set period of time. It's looking backwards to say, where has the stock been moving? Is it a more volatile stock? Does it fluctuate more frequently? Or is it a more gradual stock? Does it not tend to fluctuate in price often? The implied volatility, IV, is related to an option, and that's of course what we're here to learn about today. And then the third volatility we tend to look at is what's known as the SIV, the Stock's Implied Volatility Index, and this is the average of the near-term implied volatilities for a stock. So taking a look at the in-the-money and out-of-the-money options out for the next 2 months, take an average of their implied volatility so you can see where your option's implied volatility stands compared to the average of those around it. Okay. Now, for historical volatility, and we're talking about the past movement of the stock, that's what's used in the Black-Scholes pricing model. Now, different services. Some of you may be trading with Thinkorswim, interactive brokers. You may be trading with Options Express. You may be trading with Fidelity. You may use another service to look at volatility measurements. Different time frames are used for the historical volatility measure. Sometimes it's a 20-day volatility, sometimes it's a 50-day volatility, 100-day, 250, and so forth. We've also seen some values where it's a 30-day measurement, a 60-day measurement. It's kind of equal to the 20-day and the 50-day as well. Naturally, stocks that tend to move more frequently in larger percentage moves one direction or the other, or both directions over time, will have a higher historical volatility. Things such as biotech stocks, 2 times and 3 times ETFs, and any stock that has recent news come out of it, rumors of a buyout, things of that nature. And of course, maybe you're looking at certain stocks in a sector that had news come out on it as well, and the whole sector has been shifting wildly due to that news. More stable stocks, indexes, and ETFs will have a lower implied volatility. We think of QQQ, SPY, Johnson & Johnson, Walmart, things of that nature, big large cap stocks, stocks that have slower movement, staple stocks, for example, large caps as well. You expect to see maybe a volatility of around 10, 15%, under 20% or so, where certain biotech stocks and 2 or 3 times ETFs, we may see volatilities, historical volatilities as high as 60, 70% or even more in the case of the biotechs as well. Now, the Black-Scholes pricing model, the 5 factors we mentioned are plugged into an equation, and we're not going to go into the equation, but the 5 factors are plugged into the equation, and this should give us the theoretical price of an option. So we take the underlying stock price, whether it's a $2 stock, whether it's a $200 stock, or a $2,000 index, the strike price of the option, the days remaining to expiration. As we know, options that expire closer in time, 7 days, 10 days, 15 days out, are going to have a lower premium than options that expire 50 days, 80 days, 500 days out in time. The historical volatility and the risk-free interest rates. Those 5 factors are plugged into an equation, and this gives us the theoretical price of our option. Now, solving for implied volatility, by our definition today, the number that justifies why the option is not priced at its theoretical value, we can use the Black-Scholes pricing model to solve backwards for the implied volatility. So taking into our account what we know, we have our 5 factors that we plugged in, and we had the actual or the theoretical price of the option. Now what we can do is take out the theoretical value of the option and plug in the actual price to the other part of the equation where it's actually trading today, and then solve backwards for the volatility. Everything else remains the same. The underlying stock price, the option strike price, days remaining to expiration, the risk-free interest rates, and again, if your stock does or does not pay a dividend, and what is the rate of that dividend. But taking the actual options price, we can solve backwards, going forward, And then the number that we get, of course, is the volatility. So working the equation for underlying stock price, strike price, days to expiration, and the actual trading price of the option, we can solve for the implied volatility. What is the number that justifies where the actual options price is? Okay. Now, what causes the difference? Why are all options not priced at their theoretical value? Well, it could be related to upcoming events. Earnings, of course, is the most common one. You may see a pending patent lawsuit, and if you're a more aggressive trader and you trade the high premiums or speculate on the high premium option buying of biotech stocks, you may have an FDA Phase 2 or Phase 3 approval coming up. Recent news and rumors, anything about a merger, a buyout, a stock split, that can also help increase the implied volatility or change the implied volatility of the stock itself or in the options. And other things that may come into account are fears about the global economy going forward. We've seen this come into play recently, and of course over the last several months we've seen this come up again. And also something I noticed here recently is country policy. An example of one of the stocks I'm in is GPRE, and what happened is they're sort of a natural gas producer, importer, and exporter out of California. And I got into this position about 2 weeks ago, and shortly after I got into the position, Brazil decided that it was going to lower its export costs and import costs in and out of the country, of course, on natural gas, and that had a ripple effect throughout the entire sector of natural gas producers, because it looked like they're being priced out of the market based on what Brazil is going to be producing and what they're going to charge for it. So naturally the stock, I think I got in around $41 per share. Today it's trading at around $35 per share, just over a past 5-day, 6-day adjustment due to the global news and country policy. Another thing you may experience with country policy is if you invest in oil fields and the company you're looking at is doing leasing in a certain country, whether it's South America or continent, whether it's South America, whether it's Asia, whether it's Europe, for example, and the policies for whatever country they're in or even the continent, but if they change what they're allowing for charges or fees for leasing, or if they're even going to allow it due to environmental concerns, that could increase the implied volatility. If they're waiting on a judgment and we're sitting there and we're just seeing our option price shift with the stock not even moving because it's all based on what they're going to decide as far as the leasing goes and things of that nature. So those are all the things, and there's many others too, that could cause this shift as to why your option is trading higher than its theoretical price or why it's trading lower than the theoretical price. Now, before we get further into analyzing IV, let's look at an interpretation of how it affects the price of the option. Let's take a look at two stocks, fictional stocks, ABC and XYZ. Both stocks are trading at $50 per share. If we take a look at the at-the-money 50 strike call for both securities that expires 30 days out in time, both stocks have the same historical volatility and the interest rates are, of course, the same. But as we look at the two options, the 50 strike call 30 days out on ABC is priced at $1.50, and our XYZ call 50 strike that's also 30 days out in time is priced at $2.85. And what we would see here is that the implied volatility of our first stock, the option on our first stock, might be only about 25% or 0.25, and then the implied volatility of the XYZ option might be at 0.50 or 50%. So this is kind of the change that you might expect for an increase in implied volatility. And why is this one so high? Well, it could be just because of, again, XYZ might have earnings coming up within the next 30 days where ABC's earnings are 40 days out in time. So the earnings date on ABC and the earnings announcement won't affect the 30-day out call because it comes afterwards. Whereas if XYZ has earnings coming up in only 15 days, that 30-day call, the price of the stock and everything else is going to be changed. The effect of this event has caused the option to increase. And again, we could use that definition that due to the earnings coming up, the risk of the XYZ call is higher than that of the ABC call, even though they have the same stock price, same historical volatility, same days to expiration. Of course, other factors that we looked at might be involved in this as well. We may see things such as the merger rumors, buyouts, and so forth. And what I want to do now is change screens. We're going to go over to PowerOptions, and I want to look at the Black-Scholes calculator to see other effects on IV and what you might expect. And then real quick, we're going to look at what is the current average market values for implied volatility, historical volatility, and so forth, just to give you a gauge of what we're looking at today. All right, so let's go ahead and move on over to PowerOptions. And I'm going to use just a basic link, a basic stock. So let's just go ahead and type in, let's do GPRE right now. Let's see where that's at today. Okay, so it's at 37.05. It's up $1.16, so it's fluctuating a little bit in price. And I'm going to take the 50 call here for the October expiration that's 24 days away. Let's go to calculators and go to Black-Scholes. Now this tool just allows us to put in some values for two different options to see where they might be priced based on what our expectations are for volatility, yield, interest, days remaining to expiration. Now very simply, let's change our values. It doesn't have to be GPRE, we're just going to use a fictional stock. So we're going to set our stock price at $50, strike price at 50, set our expiration to 30 days out, and the volatility, let's put it down at 0.25 where we started before. I'm going to take out the yield for the dividend. Let's just leave that at 0. And of course, the interest rates will remain the same. Now for our second option, we want to compare them side by side. We're going to do the same thing. I'm going to put in a 50 stock price, $50 strike, set our days to expiration to be the same, a volatility of 0.50. And again, let's take out the yield as well. And let's just click Use these hypothetical numbers. And what we see here is a graph of what we'd expect for the theoretical price of the option. There's about our $1.50 for option number 1, and option number 2 about $2.85. Now this tool is also useful for seeing the chart, what you'd expect maybe for a time decay if everything stayed the same. But down below you can see a grid of what you'd expect your option price to change. So let's take a look here at expected call bid of option 1. And we see we start out about 150, but let's call it 143. And then the expected call bid of option 2 would be about 286. And of course, since it's the at the money, we use a $50 stock and a $50 strike. The graph here showing us the put bid and the call bid, they'd be about the same because it's an at the money option and no dividend is factored into this equation. And we can see the rate of decay over time scrolling down to where we get to expiration as well. Now, let's just talk about a simple maybe 0.5 change. Let's put our volatility on option 1 to 0.50, and let's change our volatility to 0.55. Okay, so now we see a subtle difference. We know we'd be about 285, 286 for the option with about a 50% volatility, but that 0.05 change, or that 5% change in implied volatility, jumped up this particular option to about, let's call it 30 cents. Okay, so maybe from about 285 to about 315. Well, is that what you should expect when comparing two options? That if you see a 5% change or 0.05 change in implied volatility, that you're going to gain 30 cents? No, because it's related to other factors as well. Let's run our same example with our same volatilities, but let's take this up to a $100 stock with the at-the-money $100 strike price. So naturally, the underlying stock is going to increase the value. As we increase that, the underlying security is going to increase the value of the option as well. So we have about 572 for call bid number 1, the at-the-money 50 strike with the 0.50 implied volatility, and then almost about a 55-cent gain, a little bit higher there for the option with the 55% implied volatility with the $100 and the $100 strike. And then, of course, as you go in the money, we're just looking at the at-the-money options as a gauge, but if you go in the money or you go out of the money, you're going to see a larger change. And as we get higher and higher to values, let's say implied volatility of close to 100%, is it going to be double of the 50% implied volatility using the same underlying stock price, same strike price? Well, pretty much close, isn't it? So we've got a call bid at 572 with a 50% implied volatility, and then the same strike on the same stock is about 1140, theoretical value, of course, on the option. So using the Black-Scholes pricing model, the Black-Scholes calculator, we can kind of gauge what we'd expect our option to be worth, but we can also see going forward if we expect a change in implied volatility, what would that be valued at as well. All right, so if you have any questions about the Black-Scholes calculator here that we're looking at or any of the values that are being shown, go ahead and send in a question. And what I'm going to do next is I'm going to show you a quick tool that I like to reference occasionally, maybe once a week or so, on PowerOptions that you may not know is there. When we talk about things such as implied volatility or historical volatility, these things that can fluctuate as the market moves, a main question that comes up always is, well, what is a good implied volatility? What is a good volatility? Well, it kind of depends on what strategy you're looking at as to whether what's good and what's bad. But in addition to that, before we can answer what's good or what's bad, we kind of have to know what the averages are right now in the market for those different values. So underneath the main Home tab here at PowerOptions, let me navigate over to there. I want to go into the Learning Center menu, one of the sub-tabs underneath the main Home tab. And from the Learning Center menu where you can access the webinars page, the different tutorials, strategy help pages, I want to take a look at the link here for market activity. And some of the things, the views that we have in the market activity tool are earnings announced this week, ex-dividends coming up this week, stocks hitting their new 52-week highs and 52-week lows, optionable stock statistics, and market statistics. Okay, so we want to take a look at optionable stock statistics. Raza asks, is there a better pricing model than Black-Scholes? Black-Scholes does make some assumptions, assumptions such as a normal log-based distribution market, logarithmic market, and things of that nature. Of course, there's other assumptions that are made in the Black-Scholes pricing model as well. Right now, there are other there are the theoretical calculators that are out there. We tend to use the Black-Scholes, and a lot of services just use the Black-Scholes pricing models as well, but you can find other pricing models that are available. And Bill asked a question about the Black-Scholes model in the option research screen. Oh yeah, that's coming up at the end. We're just going through the theoreticals right now of implied volatility and some discussion, but we're going to go through the screenings in that as well, Bill, in just a moment. All right, so our optionable stock statistics. What this gives us is an overall view of the minimum and maximum and the average, of course, for the stock last price of all optionable stocks, the average for the option bid price, option last, and so forth. You know, this here at 1174, that's one of the highest standard securities. I don't think this is looking at ETFs and indexes. But however, on the optionable stock statistics page, if we scroll down a little bit further, we can see the volatility section here as well. And so what we're looking at here is the SIV, the stock's average implied volatility index, right now is at 0.66. And the average of implied volatility of all options is at 0.59. So that gives you a gauge. If you're thinking of what is my option overvalued or undervalued, considering the average of all options in the market, well, you'd probably want to look for a value of greater than 0.59. Or if you want to look for undervalued options, you might want to be below 0.50. Now, what's interesting, of course, is we look at the historical volatilities down below. So we have implied volatility at 0.59, and then we see that recently our historical volatilities are fairly low. 20-day volatility is only at 0.27 or 27%. The 50-day volatility of all optionable stocks is around 30%, and the 100-day is around 30 as well, and then the 250 is a little higher at 33. So why is the implied volatility across the entire optionable market almost twice as high as the 50-day or the 100-day or the 250-day volatility? Well, that's due to fear in the market, perhaps. Global events, which we all know what's going on, of course, out in the Mideast and other aspects as well, the fear of China's economy, things of that nature. And also what we have to take into account is we know that we're coming up to an earnings season. Mid-October to November, we're going to see new earnings coming out for all potential stocks. We're going to be in that second quarter time frame there, or next quarter time frame, I should say. So the options are actually increased because of these factors as a whole compared to what these stocks, indexes, and ETFs have been doing over the course of the last 50 days, 100 days, and 250 days as well. All right, so let me just jot this down. It's 0.59 for IV, and it's 0.30 for the historicals, roughly. Okay, so all that said, let's go back now to our main screen. All right. Okay, so now, all that being said about implied volatility, what it kind of is, how does it affect the options price? We saw that with some of the Black-Scholes pricing models and the Black-Scholes calculators. How is this difference used? Well, naturally, as Bill kind of mentioned, options whose price is higher than their theoretical value are considered overvalued, and those where the actual trading price is lower are considered undervalued. You can measure this in two ways. Number one is the Black-Scholes ratio. This is simply the actual trading price of your option divided by that theoretical worth. So if we have a value that's greater than 1, meaning our trading price is higher than the theoretical worth, that could make us lean towards the evaluation that our option is overvalued. And again, if the Black-Scholes ratio is below 1, that would mean it was undervalued. Another measure, of course, you can use is the IV over HV ratio. What is the implied volatility of my option compared to the historical volatility of the stock? So if I have an IV-HV ratio of 1.10, that tells me that the implied volatility is roughly 10% higher than the historical volatility of my underlying stock, and that would reflect an overvalued option, whereas values under 1 would be considered undervalued as well. But why do we consider that implied volatility is a double-edged sword? Well, we kind of know that options that have that higher implied volatility, meaning that the option is priced much higher than its theoretical worth, well, we're told that if we're going to be selling premium, we want to look for options with a high implied volatility. We're going to get more bang for the buck. We're going to see higher returns, both monthly, weekly, or annually. We saw on that that time decay graph on the Black-Scholes calculator for our two different options, hypothetical options, that we'll see more of a rapid time decay if we have a higher implied volatility, and that works into our favor. We want to see that rapid time decay as option sellers, and we may also have the speculation that if we're at a high of implied volatility right now, that the implied volatility might revert back to the norm and decrease, and that allows us to buy back the option more cheaply to get a profit faster. Okay? Yeah, we don't, this is why we don't do that. I show this number, this percentage, because that's what I see a lot of investors doing. A lot of services do, Bill. Bill says IV expresses a percent of what? And that's why we chose to show implied volatility as a straight number, as a decimal point, as opposed to a percentage on power options. Because it's not really a percentage of where the implied volatility has been. And it's not a percentage of a range from 0 to 100. It's more of just a number that they use, just as we saw in the Black-Scholes pricing model, to get that number for implied volatility, and they express it as a percent. So it's not a percent out of 100, and it's not a percent of where the implied volatility has been. There's a different feature that we use to show that. So that's why we choose not to show it as a percent, because we think it's more confusing than it needs to be. To us, implied volatility is a straight number, where you may see it as 25.86, and we show it as 0.2586. Some services show it as a percent. So I just included that in there in the description because that's what you might be used to at your broker. All right. Now, what are the income strategies we might consider for selling? Well, covered calls, and of course the reverse, covered puts, selling option, shorting a stock and selling a put option against it, selling naked puts, selling cash secured naked puts, or selling naked calls. We don't advise doing that, but if you want to take on that risk, we have the tools to do that. Credit spreads, calendar spreads, buying an option farther out in time and selling a near-term call or put against it, iron condors and iron butterflies, the combinations of bull put and bear call credit spreads, short straddles and short strangles, meaning selling an at-the-money call and at-the-money put on the same stock, or of course selling an out-of-the-money call and out-of-the-money put on the same stock. We may even lump standard collars into that position as well. Now, when we talk about the double-edged sword and what we just briefly learned about implied volatility, are these strategies really what we'd want to see with a high implied volatility? Well, sure, we want to get more premium, but for a covered call, this is a neutral to bullish position. We probably have the expectation that the stock would stay above our strike price, and same risk-reward profile I would see for a naked put. And yes, we want to get a good premium. We want to get a good return, but we don't want to get caught with a future-looking event that has a high IV, let's say for earnings or for some other event. That's terrible V, there we go. Because if the stock does fluctuate wildly and it declines against us, even if we have a stop order in place, we're going to have unrealized significant losses on our position. Okay, so do we want high implied volatility? Yeah, we love high premium, but do the strategies we're looking at really go hand in hand for looking for implied volatility for selling? For the credit spreads, you have a bull put credit spread or a bear call credit spread or the combination for an iron condor. You're neutral to bearish with a bear call spread. We're neutral to bullish with a bull put spread. If our stock was trading at $50 per share, we might be selling a 45 put, so we have some good range out of the money, and buying a 40. So we look for high implied volatility in this case to get a better premium, but that might imply that some future events occurring which would cause the stock to decline, and we probably have a 9-to-1 or 10-to-1 risk-reward ratio on this, and this might wipe out 10 previous trades. And of course, reverse on the bear call side, if we sold a 55 and bought a 60 on our $50 stock, well, if the stock has a wide range up, some rumor of a buyout or merger, and then the buyout offer is tendered and the stock gaps up to 62, we're now at full loss on our credit spread. Condors and butterflies are neutral. We don't want to see any movement, as are straddles and strangles. So it's a double-edged sword. We want to see good premium, but at the same time, we don't want to take these kind of strategies. We don't want to invest these kind of strategies with that event coming up, because we can come back to haunt us in the end. The premium's great, but as the structure of the trade, it's not necessarily what we want to see. Now, investors who are buying options, you're told to look for undervalued low IV options, and again, you may have the speculation that the implied volatility will rise, so that'll increase the value of the option even if the stock doesn't move. Well, with the low IV option, you're going to have less extrinsic value. So if you're looking at in-the-money options, you're going to have the intrinsic value, but then with the lower IV, you're paying into less time value, less extrinsic value. Lower comparative cost, of course, to options with a higher IV. You have less time decay because there's less premium to decay over time. And the speculation is that the IV is going to rise, and that would increase the extrinsic value again. And the long strategies we talk about, of course, you may be looking at buying long calls, speculating on a market movement, maybe 60 to 90 days out in time. Buying long puts, long-term debit spreads, kind of like credit spreads, but long-term debit spreads, and then, of course, buying straddles, buying an out-of-the-money call and an out-of-the-money put, maybe for an earnings play, or strangles. I'm sorry, strangles would be the out-of-the-money, straddles would be at the money. So those are the kind of positions you're looking for. But if we take into account, if I run a search specifically for options that have a low implied volatility with earnings coming up, well, I may see stocks such as Johnson & Johnson, Walmart, QQQ, SPY, the things that we saw earlier in the presentation with the low IV. These are stocks that tend to, for example, Johnson & Johnson and Walmart, these are stocks that have shown growth over time. But this is not the stock that you're going to expect to get a high leverage return on buying options against. It's not something that's going to swing. Even if Johnson & Johnson has earnings coming up, let's say in the next 20 days, and your long call has a low IV that you're evaluating, maybe slightly in the money for Johnson & Johnson, 60 to 90 days out, so you can get advantage of the earnings. Even if the earnings come out and they're really strong on Johnson & Johnson, because of the way the stock performs, you might only see a 4 or 5% gain on the stock. And that might increase. You might have a profitable trade. That's very true. But at the same time, it's not something that's going to gap up like Starbucks or Green Mountain Coffee Roasters, where at times you see a 15 to 20 to 30% jump in the stock price and the underlying security. But of course, that option has a higher IV, so to take advantage of that wider swing, I'd have to pay more money into the long call to begin with, or the long put if I'm speculating on the downside, because the IV at the starting point would be higher and it would be a much higher cost as well. Now, I'm not saying that it's not important to know the implied volatility for the position that you're entering into a trade. Okay, we want to know the IV. It's important to know the implied volatility because it gives us a gauge of expectation going forward. It also gives us, is your option overvalued or undervalued? And then another comment on that is, does that matter if your option is overvalued or undervalued? For spreads, a lot of investors tend to compare the IV ratio, especially for calendar spreads, and credit spreads. What is the implied volatility of my short option compared to the implied volatility of my long option? And then something that's a little bit more important probably, if you're speculating on market movements one direction or the other, is what is the range of implied volatility, the percent implied volatility range, meaning where is my implied volatility of my option now compared to where it has been over the life of the option? And that's what we want to take a look at next, is actually using the implied volatility for our trades and evaluating it going forward. Using the PowerOptions tools, we can screen for IV. We can screen for the ratios as well. We can screen for the percent implied volatility range and IV ratios for spreads and calendars. And we also have a volatility skew tool as well. Okay, and real quick, Bill asked a question. In the past, I've attempted to screen for stocks that have an IV greater than 100 but got no results. I have to leave that one early, but would you go over what I did wrong? Yes. As before, Bill, I mentioned that we're looking at IV in PowerOptions and volatility on PowerOptions related to the decimal. So if you're looking for a value of an IV of 100, you'd want to run a screen of an IV greater than 1. Not 100, but greater than 1. So if you're looking for an IV of 50, it would be 0.50. What your broker might show is the 50 or the 50% or a volatility of 100.01. Well, you'd be looking for an implied volatility ratio or implied volatility number on PowerOptions of 1.01. Real quick, Bill, let's walk through that if you're still on the screen. Before I do that, I just want to launch one quick poll here. It's going to be very easy, but it'll help us gear the rest of the presentation. What I want to know is what types of option strategies are you trading right now? You're mainly looking at just covered calls and naked puts. Are you focusing more on the protective option strategies, married puts, collars? Are you looking at option buying, long calls, long puts, speculating on a market movement? Is your focus mainly on the credit spreads, bear call credits, bull put credits, iron condors? Or are you looking at combinations, calendar spreads, straddles, strangles, and so forth? All right, I've had the poll open for about 45 seconds. The majority of our audience has voted. I'm going to leave it open for another 10, 15 seconds or so. So if you haven't voted yet, I encourage you to do so. All right, let's go ahead and close that poll. Still have a couple of votes coming in. We've got the majority. Let's go ahead and close the poll and let me share the results with everyone. All right, so what we see here is we have 62% of our audience doing the credit and debit spreads. Second place is a tie, it looks like. 38% are buying options and 38% are doing covered calls and naked puts. 31% of you are doing the protective option strategies and 27% are doing the combinations, calendar spreads, straddles, and strangles. Okay, well, go ahead and take a look at our other strategies tab where we can customize our view in PowerOptions. Well, I've got the iron condor and the bull put credit in slot 1 and 2, so we'll leave that there for the 62% right now. 38% are doing option buying and covered calls. So let's go ahead and move long call up. And we've got covered calls and naked puts. And let's see, 31% are doing the protective option strategy, so we'll leave married put there as well. And I'm going to go ahead and remove the custom spreads for the time being. And let's go ahead and add in calendar call. And at the same time, I'm going to want to, let's put in some straddles there, some long straddles, maybe long strangles. Let's go with long strangle for the time being. Okay, so let's go ahead and save that, so that'll take into account what everyone's doing, essentially. We'll take a view of what everyone's doing. Let me just make sure that we're showing the proper screen. All right. So the important thing first for credit and debit spreads, let's take a look at those first. I'm going to go into the bull put credit for the time being. And let's just go into the search. Now, for every strategy, once you click on the search, it's going to link you to a basic view. I'm sorry, it's going to link you to the view, of course, of the trades that match either one of the PowerOptions default screens or the last screen that you were viewing. This one is from our September 19th webinar. We created a screen when we were doing the Greeks presentation. Oh, no, I'm sorry, this was last week's open discussion, open forum on Friday afternoon. But as we mentioned, we can screen specifically for about 20 to 30 different options criteria, about 20 different stock fundamentals and stock technicals. And you'll see the same setup for every strategy. And for bull puts here, we see that we have fields where we can screen specifically for implied volatility, the implied volatility of our sell option, and the implied volatility of our buy option as well, in addition to the implied volatility ratio, which we feel is the important factor of looking for in spread positions. It's the implied volatility of the sell option divided by the implied volatility of the buy option. In theory, of course, for any strategy combination, whether it's a calendar spread, whether it's a credit spread, when you're buying one and selling one, you'd probably want an implied volatility ratio of greater than 1, just what we talked about before for just the IV over HV of an option, or the Black-Scholes ratio as well. And why would we want that? Well, because we'd want the implied volatility of our sell option to be much higher than the implied volatility of our buy option. Because in theory, if I'm entering a spread, I want to be selling into higher premium and buying into lower premium. This, again, has its own factor of the double-edged sword comment. And the reason why is if I'm looking at a stock that has a higher premium, a higher volatility, let's talk about GMCR, Green Mountain Coffee Roasters, Starbucks, for example, or something with earnings coming up going forward. Well, if one option has increased implied volatility due to an upcoming event, the lower option will also have a relatively increased implied volatility as well. You can't expect to enter a spread where the implied volatility of your short option is 0.87 or 87, and then your buy option is 0.10. Okay, it's not going to happen that way, because if one option on the chain is inflated, has a high implied volatility, the other options will as well. But in general, let's first take a look at Bill's comment there regarding the, let's just see if we can get anything. Before we do anything else, I'm going to clear everything out. I'm going to clear all the stock and all the option criteria. And I'm just going to set standard expiration. Let's just go to standard October, and I'm going to look for implied volatility of greater than 100. Implied volatility of sell option of greater than 100. Let's go ahead and submit that. Okay, and nothing matches our search criteria. And I'd expect that, because the highest range we're probably going to see, there are going to be options out there that have what you might call a 200 implied volatility or a 300, but we express that as a numeric value. So if I wanted to see options that have implied volatility of greater than 1 or 100, we'll just put in 1 to blank, submit that, and we're going to get a wide range of results. Okay, we're going to have over 500 results. And there's a lot of things in here, the Gold Trust ETF, First Majestic. Let me increase this up to 2 just to get a gauge. Let's just put our implied volatility here up to 2 for our sell option. And we haven't put any restrictions of out of the money, difference in strike prices, and so forth. We see Arch Coal is extremely high. These options that are out of the money are extremely high. Rocket Fuel, a lot of low-price stocks that we can see here as well. I was hoping to see, and we probably would if we changed the criteria a little bit, but I was hoping to see more biotechs, and we will. Here's what we're going to do. We're going to keep our implied volatility at greater than 2, and I'm going to go at least maybe 2%. Let's go 3% out of the money for our short option. Remember, on our bull put credit spread, we want a reasonable probability of about 65% or higher. And I'm going to set my strike difference equal, let's just go to 5 points, just to kind of filter some of these out. Now that basic view, not looking at any other stock or fundamental criteria, let's go ahead and run that. Okay, so Alcobra is the only one that comes up. And we see some deep out-of-the-money securities here. The stock's at 2068. We could sell the October 12.5 for 240, buy the October and a half for 0.90, so get a net credit of $1.50 for potentially a 42.9% return. Well, first, let's take a look at the chart. Is this something that would make sense for a bull put credit spread? Well, it's been down to 16. It moved up to 22. It did that recently and dropped back down to 16. Even though for a 12.5, it hasn't breached there recently. But again, why is this so high? Well, it's probably due to some kind of event coming up. So let's just go to the research tool real quick. I'm going to take a look at the stock research tool for this position. Let's see. So the earnings are coming up on 11/6. It's unconfirmed. So we remember looking at the October series. So it's not the earnings that's affecting this so much. There's got to be something else. So now I'd have to take a look at the recent news going back. Completion of all patient visits in phase 3 clinical trial. That was on September 19th, so that's why it jumped up from about 16 to about 22. The day before, oh, let's get rid of that ad. The day before it had moved up 5.1% in anticipation. So they've completed all of the patient visits in the phase 3 clinical trial, but that doesn't mean that the phase 3 trial is over. So there's still probably a pending FDA approval going forward on whatever drug that they're testing, and we'd have to delve further into this to figure out what is going on and when is that, and if it comes out before this October series, that could have a great effect on the position. If it fails at FDA 3, this stock might drop down to $4 per share. I've seen that before. couple years ago, there's a couple stocks that were dominating the search results for things such as naked puts and covered calls even, and other strategies. I can't remember the exact stock, but it was about $12. And you could sell you could do a covered call. You could buy the stock around 12. You could sell the out-of-the-money 14 call for $4.37. It's something ridiculous. Drops you down to 8, and you'd get assigned and make $16. So it was about a 100% return if you were assigned at expiration on this position. Well, the FDA Phase 2 approval came out, and that drug failed. The stock dropped down to $1 per share. So yes, you've hedged your $12 stock $4 to an $8 investment, but now you've lost about 87% of that with the stock trading at $1 per share. And what happens then? Well, when the stock collapses like that in these higher volatile situations, what you end up seeing is that now the implied volatility goes to nothing on that particular stock. Stock's trading at $1. You might be able to sell a $1 call or a $2 call, but it's only going to be worth 5 cents or 10 cents. There's going to be no premium available there simply because the implied volatility is dried up. The event happened, and now you can't get anything back for it. So you've got a $7 loss in your stock after taking in the $4 premium. You've got a stock trading at $1. If you're only getting 10 cents in premium for the at-the-money option, well, that's going to take you about 70 months to get back to break even. It's kind of rough, isn't it? Okay, so we just wanted to show that as an example and to show Bill, why it didn't show up when you're screening for 100. It's because we're doing the single number value. If you're looking for an implied volatility, if you're used to seeing it as 50, you'd look for an implied volatility of 0.50. Now let's talk about our implied volatility ratio as it relates to credit spreads and debit spreads and condors. Again, we may think that, well, I'm selling one option and buying the other here in my bull put credit spread, so I might want a really high implied volatility ratio, maybe greater than 2. All right, so I want the implied volatility of my short option to be twice as high as the implied volatility of my long option. Right? Because in theory, I want to get as much as I can for the short option, pay as little as I possibly can, and have less inflation on the option I'm buying. So let's put an implied volatility ratio of 2. Again, we'll just keep October for standard expiration, and let's put in no other filters, including strike difference and so forth. Let's go ahead and submit that. We will see some results, I bet. Okay, and yeah, so what are we seeing here? We're seeing those. Okay, well, first off, we wouldn't do any of these first listings. Why not? Well, let's take a look. We've got a stock here at 30.71, and remember, we're looking at a bull put credit spread where we have a risk-reward profile such as this. We're selling the out-of-the-money option, and we're buying further out-of-the-money option, and we'd want the puts to be below the current stock price. Well, here Barclays shows up at 30.71. It shows us we could sell the 43 deep in the money put for 12.30 and buy the October 34 for 3.40. That's not what we want in the structure of our trade. We want to be out of the money, and we want to have a reasonable probability. So let's just make that change quickly. We'll keep this implied volatility ratio. Again, let's go at least 3% out of the money for the short put, the put we're selling, and keep a probability of around 70%. Let's go ahead and run that. Okay, so now we have 22, and there's some ones here that look pretty good with the SPX and Yamana Gold going forward as well. But let's go ahead and take a look at these actual values. Okay, because everything does kind of go hand in hand. Let's go into choose columns now. And for our bull put credit spreads, we want to see the sell implied volatility, the buy implied volatility, and the implied volatility ratio as well. Let's go ahead and submit those. Let me prompt it, of course, to close the window to refresh the page. Okay, so these, again, you have a high ratio, but you're not seeing probably the volatility you'd expect. For the SPX, you have a volatility of 0.15 to 0.07 for the deeper out-of-the-money option. Well, you're still looking at a reasonable premium here, I guess, of 5.58, but going this range out of the money, what we may also see as we further research and analyze this position might be a large bid-ask spread. There might be no volume and no open interest. But we see here that a lot of these values on SPX, they're extremely low. Okay, so these aren't high implied volatilities, but they have that high implied volatility ratio as well. Look at some of these other positions, also deep out of the money. Bank of America, well, not too deep out of the money, but Bank of America at 17, selling the October 15 for 2 cents and buying the October 14 for 1 cent, so a 1-point spread and a 1 cent net credit. Look at these returns. Okay, these returns aren't worth the trade, even though you do have a high IV ratio. Okay, because again, if you're looking for something that has a high implied volatility to get more bang for your buck, which I don't necessarily recommend, but if you also look for that high implied volatility ratio, when you find these higher implied volatility ratios, you might not be seeing the implied volatilities you expected to see, say 1.5 to 0.75 or something along those lines. And at the same time, the structure of the trades you're looking at probably don't match what you want to see for your spread. Okay, so let's keep it more realistic. And without even using things such as the implied volatility ratio or my range of implied volatility, I'm going to actually go back to that default search we created that we saw on September 19th, and I'm going to talk about why I'm using this. Let me just go ahead and run this screen. Now, the reason we created this screen is last Friday, the question came in of what kind of criteria would you use for a bull put credit spread. And we're talking about a bull put credit spread. What do I want? Well, I want a stock that's showing neutral or stable growth. I want a good growth stock. I want something that's shown good management. I want stock that has good liquidity, is probably trading in an uptrend, and to be honest, I'm going to avoid a stock that has earnings between now and expiration. So we put in that we were looking for stocks that had an average stock volume at least 750,000 shares traded per day over the last 90 days. I want to see a stock trading above the 50-day moving average. We want to see stocks that have a growth of at least 5% or more. PE ratio, keep it balanced between about 0 to 50. And I wanted to look for mid to large cap stocks. I don't want any small cap stocks that tend to have more volatility, which again might be great for my premium, but it doesn't match the structure of what I want to see. I don't want stocks that tend to fluctuate more wildly or will have more of an effect based on the news. And of course, we want to avoid earnings between now and expiration and these types of income strategies because I don't want to see that stock that takes the 25 to 30 to 35% decline due to a poor earnings, and then I end up taking the maximum loss on my bull put credit or a very high unrealized loss on my covered call, where I now be forced to manage it for 8 to 10 to 12 months just to get back to break even and so forth. Okay, so those were the stock criteria we were looking for. And this was a weekly screen, by the way. So we were looking for days to expiration between 2 and 10. Wanted a minimum net credit for my spread of 15 cents or more. Return, of course, greater than 2. Wanted some liquidity on the options and starting off with a probability of 70% or greater. Now, this stock criteria I mentioned is probably the same things I'd use for covered calls, cash secured naked puts, standard collar positions as well. You want to see good stable stocks that have good liquidity and good volume going forward. Now, why did I bring up this search to begin with? Well, we only have 21 results for the next week out, 10 days out. There's only 21 spreads that match that criteria. And there are some ranges here. There are some positions that do have that implied volatility ratio of greater than 1. I apologize, there's only 1. But what I wanted to show you is that based on the structure of the trade and what you'd want to look for going forward, notice that these implied volatilities for our short option are all under about 0.33, 0.34. Okay, 0.3373 or 33.73 is the highest implied volatility. And this is because the structure of the trade, again, is probably more important than what you've been told about screening for high implied volatility when you're selling positions, which can get you into a lot of trouble. And, of course, buying into low implied volatility, which means you may never see movement on that option, and you may never see gain on your option position if the stock doesn't move. So if you're using criteria that match the structure of what you'd want to see, you're likely going to already be filtering by implied volatility without using it. Now, of course, you might say going forward, I'm not saying that you don't need to, that you should ignore the implied volatility. What I'm saying in this case is that you can use this now as an extra analysis. If we looked at these positions and you want to focus on the implied volatility ratio, your eyes might go directly to this position on Gilead Sciences that does have the IV ratio of greater than 1.02. It's not much, but it's the only one that has that IV ratio of greater than 1. And then we'd further evaluate, of course, the stock and the position, of course. The stock's at 107.93, and I have to take a look at the 105 strike and the 104. when I look at the chart, is this something I have the expectation is going to stay above 107 going forward? Okay, so that's what we wanted to talk about with as far as the structure of the trade. And I'm going to go into a single option strategy right now. I'm going to go into covered calls. And we're going to talk about some of the other features that are shown for implied volatility when you look at a single option position. So we just looked at implied volatility ratio, which you'll see in the spread positions, the calendar spreads, straddles, of course, I believe strangles, iron condors, and of course the credit and debit spreads. Those of you that are doing more of the single option strategies, covered calls, naked puts, even option buying calls and buying puts, and even married puts as well, you'll see a little bit difference in some of the values that you can screen for in the implied volatility section. So now we can screen specifically for our implied volatility number, and what number would I use? Well, again, if you're interested in taking more of an aggressive position with selling your positions, and you wanted to look for what you'd consider a high IV, remember that we saw earlier our average IV across the market right now is 0.59, so you might want to look for a range that's greater than 0.60 to see options that are higher than the average across the market. And of course, if you wanted to make sure your option was overvalued or undervalued, if we were doing call buying perhaps, for an overvalued option again, for the IV over HV ratio, I might look for a ratio of greater than 1 or greater than 1.10. And IV over SV, we would do the same thing. Remember, that's the stock's implied volatility index, the average of the implied volatilities for the near-term options. So you might want that to be above 1 as well. But another feature that we have here that you can screen by is the percent implied volatility range. So maybe more important that the implied volatility screen that you're using, more important than the actual implied volatility of the option, or if the option is considered overvalued or undervalued, okay, then the percent implied volatility range where the option is now compared to where it has been over the life of the option would be the same. Now, Raza asked a question, can you speak for the criteria used for naked puts, especially IV? Well, what I do for covered calls would be the same thing I'd use for naked puts, honestly. But again, I'm going to approach this a different way. And first, what we're going to look at, without looking for overvalued or undervalued options for IV over HV or straight implied volatility, let's clear out our entire filters. Okay? Now, for, again, what we saw before, we just used for bull put credits, I'd use that same stock criteria that we saw in bull put credits that I'd use for bull call debit spreads, probably calendar call spreads if I'm buying an in-the-money call forward in time and selling a near-term call, standard collars, covered call positions, and naked puts. It doesn't have to be the exact same criteria. I'm not trying to give you recommendations or suggestions. I'm showing you what I would likely use because I want to see the same thing. And all of those neutral to bullish strategies with income, I want to see strong stocks. They're showing good management. They have good liquidity. I'm going to avoid earnings between now and expiration. I probably want to see stocks in an uptrend. That's another thing that's probably filtering out some of our results right now because of the large declines we've had recently. And at the same time, I'm going to want to see maybe just mid to large cap stocks. So that being said, let's go in the fundamentals. We're doing a covered call screen now, but I'd use the same criteria for a naked put. And to start off in the fundamentals, again, I want to see stocks that have grown 5% minimum in earnings. I want to keep that PE ratio personally between 0 to 50. You might have a different preference. You just plug that in. I prefer to look for mid to large cap stocks, and you can hover directly over that criteria, and it'll show you what are the ranges that are considered for a mid to large cap stock position. And then this is actually measured in millions, so if I want to see mid-cap stocks, I want to look for greater than 2,000. So go ahead and plug that in as well. Also under the fundamental screen, I want to avoid stocks that have an earnings date between now and expiration. Now, one other thing that I eventually do for my covered calls, cash-secured naked puts, for example, I know my underlying stock price. I mean, I know my account size, so I know what I can afford to buy for a stock or what I'd put up for a cash-secured naked put. Or you know your margin if you're doing naked puts, and they allow you to do a 50% or 40% margin for your naked put allotment. But that's going to help dictate what you can afford for underlying stock price. Okay, but I'm going to leave that blank for right now. We're not going to use the stock price range. Let's go to technicals. And again, the average stock volume was something we saw. I want to use a range of greater than 750,000. And if you use other things such as the RSI, we could plug in our historical volatility if we wanted to screen to it, but you know what? I'm not going to. And at the same time, I want to look for stocks that are trading in an uptrend. Okay, so I'm going to select just stock to be above SMA 50, but if you want to use the 20-day to be greater than the 50 to be greater than 100, or so forth, you can put in what you'd want to see for your overvalued or undervalued movement. Now let's go into the options criteria. I'm going to start off with standard October expiration instead of looking at weekly, so let's go ahead and put in October. And if I'm doing a 30-day out or 25-day out covered call, I probably I have some trading plan in mind where I'd want a downside protection of maybe at least 3% or so. I'm going to want a minimum maybe 2.5% if assigned, and maybe a 1% if unchanged. So if the stock hits the maximum, stays above the strike price, I want to look for positions that will at least yield 2.5 or maybe 3% or higher. I want my downside protection to be greater than 3% as well. And the percent if unchanged, if the stock stays right at the current stock price, whether the option is in the money or out of the money, I want at least a 1% return if unchanged if the stock doesn't move. Now, I'm not going to put in anything for range in or out of the money, and I'm not going to put in anything for the implied volatility, the implied volatility ratio, or the Black-Scholes ratio, which is similar. We would look for that value of greater than 1. And here in the Black-Scholes ratio, it shows us the 50-day. That means it's using the 50-day historical volatility. And you also have the Black-Scholes ratio where it's using the SIV, the Stocks Implied Volatility Index. But the other things I'm going to look for is I'm going to look for an option volume today, let's say of greater than 10 contracts, and an open interest of greater than 100 to see some good liquidity on the various options as well. Now for Roz's question, the only thing that would be different for me personally in the naked put screen would be the return field. I'd use the same stock criteria for the underlying security because I'm looking at a neutral to bullish position. Okay, with the naked put, I'm of course going to be a little bit out of the money potentially, so I might have used 1% out of the money. But you don't have fields such as percent if assigned, downside protection. What you'd see is percent naked yield. Well, based on your trading plan, you'd put in what you'd want to see for the yield, maybe 1%, maybe 2% for a 10-day trade, or 1% for a 5-day trade, 10-day trade, or maybe you go up to maybe 2% naked yield, going slightly out of the money for a 30-day trade, standard expiration. And instead of downside protection, you'd see a value called percent to break even. And what that reflects in the naked puts is how far the stock can drop before you hit the break even value. Okay, so it takes into account the premium you received and how far would the stock need to drop below your strike price before you start losing money on the position. So you might use a percent to break even of greater than 3 or 4% and a percent naked yield. Depending on your goals, you might be looking for 2 or 2.5% as well. Okay, so let's just go ahead and run this search for the covered calls using the stock criteria we mentioned and the premiums we wanted, and we only have 10 results. First Solar's in there, United Continental Holdings, Gilead, Baidu, and Best Buy. And you notice we're pretty much close to at the money with these positions because that's giving us the return we wanted with the downside protection. If I went deeper in the money, we'd have a much higher downside protection, but we'd have a lower percent return if assigned. And if I was speculating with out of the money covered calls, or just at the money naked puts, you'd have a higher percent yield but a lower downside protection or lower percent to break even. So there's very few results here, but once again, let's go into choose columns and let's add in those values that we saw. Okay, and of course what we're referring to there is the implied volatility of the option, and we want to see the percent implied volatility range. I'm going to add that in as well. Is it up higher? I'm sorry, folks. And what I also want to look for, of course, is the IV over HV ratio. Check that box. And why not? Let's add the IV over SV ratio as well. Okay, so I'm just going to add those in. Let's click Submit and Save. Close the window. It's going to keep the same criteria, but now we're going to see our ranges. Once again, the structure of the trade, what I'm looking for with my covered calls, this is what I'd expect to see. Without screening for implied volatility, we've kept this criteria within a strict range. Looks like our lowest implied volatility is 0.3064, and our highest up at the top is 0.4707. Okay, so or 47.07, however you want to refer to it, which makes sense, of course, because the option that has the highest percent if unchanged, percent if assigned, has the highest implied volatility of those that matched our results. But yeah, I just wanted, this is what we were referring to, is that is implied volatility important? Of course, I want to know where my implied volatility is. But is it necessarily important to use as a screening criteria? Not necessarily. If you're putting in criteria for your covered calls, naked puts, even your long calls and long puts, for example, credit and debit spreads and so forth, if you put in for the proper structure of the trade of what you'd want to see, okay, what makes sense for the position, neutral to bullish, neutral to bearish, some good management criteria, you're going to see positions that are already in with a tight implied volatility range. Of course, it never hurts to look at these values, the ratio of IV over to HV and IV over historical volatility, because it shows us that our options are overvalued. Most of the options here are all overvalued compared to those ranges. But let's take a look at Best Buy. And this is not a recommendation or suggestion, but I want to point something out here. And Best Buy is trading at 33.78. We see sort of the at-the-money 33.5 strike call for $1.18 premium. This gives us our 2.8% return if assigned. We have a 3.5% downside protection. Now that I have my trading results, what I'm going to do is do just what we did before when we were looking at the bull put credit spreads on a la Cobra, is I want to go through and I want to take a look at the stock chart, the company information, look at the research, see if there's earnings, what dividends are coming up as well. Of course, I could add those directly into my columns here. But we're going to research these positions to make sure it's something that we want to get into. Well, if I've gone through all of these positions, and for whatever reason I decided that I didn't like First Solar, US Silica, Baidu, Gilead, and so forth, and I decided that Best Buy, for whatever reason, had the best sort of stock chart I wanted for my covered call. It matched best the structure of a covered call trade, the kind of chart I want to see with a covered call, and I know I'm happy with this return, the percent if unchanged, and of course the downside protection. And I have a good probability here. It's one of the highest probabilities that we'd get assigned and earn that maximum return. So if all that comes into play, and this is a stock I'd want to enter as a covered call trade, am I really overly concerned if my IV over HV ratio is less than 1? Am I concerned if the market considers that undervalued? Not necessarily, because it has the return I want. Maybe it has the minimum premium I want. It's naturally within the stock range I would have selected, and it has the downside protection that I want as well. And once I did all the research and analysis, I was most comfortable with this position. I'm still going to trade the position even if it's considered undervalued because it has the return that I want. Okay? So I'm not saying that you don't want overvalued options if you're selling. I'm not saying that if you don't want undervalued options as well. What I'm simply saying is that a lot of times you may find positions that match your criteria for a given strategy. And if you're selling the option, it might appear undervalued for the IV over HV ratio. That doesn't mean it's a bad trade because it still matches your trading plan, which is probably more important overall than what the market considers to be overvalued or undervalued. And the reverse of that, if we were looking at a long call screen and we found a long call that once we did our research and analysis has the ask price that we want, is on the stock we want going forward, or let's say even a long straddle or a long strangle for doing an earnings play going forward, and they're overvalued options, well, honestly, that's what I'd expect to see. If I'm buying a long call or if I'm doing a straddle, even if the expiration of the options are 3 months out in time and the earnings is coming up in 15 days, if the options are overvalued and I say, oh, I don't want to trade that necessarily because the options are overvalued compared to their historical volatility, well, I should expect them to be overvalued because the whole market knows the event that's coming up. There's that inherent risk again, the future-looking risk of the option because of this event. But if I'm bullish or bearish, and I'm taking that speculation that there's going to be a wild swing in the stock, either just with a directional long call or long put, or with a long straddle or strangle hoping for either direction, then I have to pay into that increased value in order to get the advantage or the increase in profits from the swing that I'm expecting. Okay, and Ron says, why would you prefer BBY if FSLR offers better figures in each category? Well, it's not what we've spent time looking at today. Okay, let's go ahead and clear out the drawings. Here's the thing. It has, First Solar has better premiums here, okay, better downside protection, better return. 296 premium for a slightly in-the-money covered call. Doesn't have as high a probability of getting assigned. Okay, implied volatility is there. IV over HV is the highest on the range. Okay, oh, so you're looking 2 lines lower. Okay, so the probability is about the same even for this one, slightly in the money, 67.5%, premium of 320. Again, 4.7 downside, 3.8% if assigned. 1.52 again overvalued, 1.03. Percent implied volatility range is 52%. So over where it's been the life of the option, it's about halfway to where the implied volatility has been. So okay, so what you're asking, Ron, is why am I taking this based on this? Instead of BBY, why was I analyzing that one? Well, first off, I wanted to analyze that because that was one of the two on our list that are undervalued, okay? And you say, okay, Ivy may not like the dog, but she could have both. That's true. But when I was going through my description, what I have to do with each of these positions before I decide to make a trade, I was trying to cherry pick and bring up a point run with this particular one showing that it's undervalued. But you're right. I'm not saying that I wouldn't trade First Solar because it has the better values. What I'm saying is that before I reach this point of making this trade, I'm not just comparing what's on the screen. I want to take a look at this stock chart here. I mean, that's my first step. We have other archived webinars where we walk through exactly, and I think there's even a help video here. Let me see here. Let me go into the help videos. Oh, yeah. Take a look later on, Ron, in the help videos here on the More Information button overview. I don't want that to start playing. There we go. And what this walks through is my process of what I do now that I have my results to pick a trade. Okay, so the first thing I'm going to do, stocks at 68.24, we're looking at the October 68 and 67.5 strike comparatively that have better numbers than the best by trade. The first step I always do is I have to look at the chart. Everyone has their own way of evaluating these different positions, right? Everyone has their own way of reading a stock chart. But if for whatever reason I go to the stock chart here, and let's just clean this up a little bit. I'd go to 6 months, and let's use a 20-day SMA. I was going to add a few quick things in here. Sorry, folks. All right. Okay, so for whatever reason, we're down below the 20-day moving average, but we know we're still below the 50. We see here the MACD is pulling down, and it's declining rapidly. Okay, and the stock has been moving up, and then it's hit a condensing period, and it pulled down below the 20-day moving average. So this is kind of more important. Yes, First Solar has better numbers, but remember, I'm selling the 68 call, which would roughly be right around here, the 67.5 call, which would right be around this area. If I'm concerned, based on these factors, and there's other things I might select, but if I'm concerned of these factors that this is a downturn, I don't want to enter this as a covered call trade. I want to look for a stock that's more neutral, it's a bullish, and that I have the expectation in the next 24 days is going to be a higher price. Yeah, screening is the beginning, not the end of the choice process. And I'll admit freely, Ron, I understand what you mean, that it wasn't maybe a fair assessment because I was cherry picking looking for these two options here that were undervalued. Compared, the IV over HV was undervalued here for Baidu and for BBY. I could have taken either one. But I wanted to use that as an example that going through, if I nixed all these previous trades because I didn't like the chart or I saw something in the chart and how I read the pattern that makes me think this is a bearish position going forward that looks like it's pulling back, that's not what I want for my covered call. So if this is the best choice based on the final process, as you mentioned, Ron, then I might be okay if the option is considered undervalued because it matches my other criteria and including my direction for where I think the stock's going to go. All right, now the last thing we wanted to discuss very quickly here, and we're about 15 minutes past the hour. If anyone does have any last-minute questions, go ahead and send those in to us. But I added in this percent implied volatility range for our screen. We didn't screen by it, of course, but I added that in. And again, you know, the concept here is that if you're selling premium, you may want to look for options that are at the higher range of their implied volatility range. Okay, so where's the implied volatility been over the life of the option? Where's the implied volatility now compared to where it has been over the life of the option? Theoretically, when I'm selling premium, covered calls, credit spreads, cash secured naked puts, collar spreads, I want the sell option, in theory, to have a higher implied volatility range, maybe greater than 65, maybe greater than 70. Why? Because the hope is the implied volatility will revert back to its norm, and if the implied volatility decreases, my option price will decrease. The option that I sold, my option price will decrease without the stock moving necessarily. That means I can buy it back more cheaply, maybe realize my profit earlier. Of course, if you're buying options, the theory is you might want to look for a lower implied volatility range because you hope that it might revert back to the norm. So I buy at a lower implied volatility range of maybe 0.2, maybe 0.25, And if it moves back to the average, around 0.5 or so, my option premium might increase even though the stock hasn't moved, and I might be able to sell it for a higher return. But again, you have to take everything hand in hand. And if you're using the percent implied volatility range, by the way, I do. Okay, when I'm looking for my married puts, the radioactive trades, where I'm buying a stock and buying a 6-month output that's slightly in the money to keep my risk at only keep my risk around 3 to 7% or so, I'm looking for positions that are in the lower implied volatility range. Okay, and I do that with my option buy suit, not too low, but maybe less than 0.6 or less than what we'd call 60%. The reason why is I got into a position, a protected put position, 2 years ago on El Paso. It was an LLC, as El Paso Pipelines, excuse me. And the position was good. I had a maximum risk of about 7%, so if the stock completely fell out of bed, the worst I could do was 7% loss. But I got into the position, and I wasn't paying attention to this, I got in the position when the implied volatility was around 80%. So 5 days into the trade, 5 to 7 days into the trade. The stock didn't move, but all of a sudden my option went from about $7 premium to about $5.50. And nothing happened. And the stock didn't move. It just suddenly, all the time value, the extrinsic value that I paid into sort of vanished. And what it was, the percent implied volatility went back from where it was near the high and dropped back below the norm. So the implied volatility essentially decreased from, what was it? It was around 0.687 back to about 0.39. And that just took out the premium for that far out option. And it was because of one of those things I mentioned before, the leasing agreements with old El Paso or El Paso Pipelines. They had a leasing agreement in South America, I think it was Uruguay, and they decided to change the leasing concepts, and they decided that due to EPA regulations, there was a ruling coming out that they might not even allow El Paso to do that. So what happened is they did block it at that time. Of course, there's going to be appeals, but when they blocked it, that was the end of the forward-looking event that could have come out anytime. It could have come out a year from now, or it could have come out 2 days after I got in the trade. And that's what caused the flux. So in buying, you may want to look for a lower implied volatility range. When selling, you want to look for a higher. But again, I want to emphasize that everything goes hand in hand. Let's take a look at U.S. Silica, 64.81. The October 65 call has a percent implied volatility range of 77%. So right now the implied volatility, 0.4707, is, near the high, 77 percentile of its high of where it's been over the life of the option. I'm going to go to research. I'm going to option research for the call. This is another important tool I wanted to show. If you guys really delve into implied volatility, there's nothing wrong with doing that. But down below, when you go to the option research, whether you're looking at the option chain or a search result, if you want to research and you select the option, down below you can see a graph of where various criteria have been over the life of the option. So I'm comparing option bid here to implied volatility on this historical graph for the option. You can change that if I wanted to compare, let's say, percent if assigned, Black-Scholes value, option volume, open interest, time value, and delta as well. You can compare different things on this particular chart. But what I wanted to focus on here, and this one's not too bad. So right now our implied volatility, again, is around 0.4673, and the implied volatility range has been 0.27 to 0.53. If you're using the percent implied volatility range in your analysis for any strategy you're doing, I encourage you to also add the numerical implied volatility range to your columns also. And the reason why is this one is favorable. We know it's been at 0.53 before. The implied volatility is at 0.467, so it isn't naturally 77th percentile, 75th percentile. But if it pulls back and reverts back to let's say 40, or pulls back even to 0.39, well, that would cause this premium to decay even without the stock moving, which is favorable in this covered call position, right? But the reason why it's important to analyze this number in addition to the percentage is that I might see an implied volatility range of 95%. My percent implied volatility range might be at 95% on an option, but if the total range is just 0.30 to 0.33, and I'm currently at 0.33 or 0.32, well, that's not really a wide range for an option that's been on the market for 3 to 4 months, okay? That's the key, is that it's great to know the percentage, but you also want to know the range, and does that really affect you as well? So that's how I use this percent implied volatility range that you'll see on the single option strategies. Again, if I'm buying, I may want to be less than 60% of my percent implied volatility range, maybe less than 50%. If I'm selling, I might want to be greater than 40% or greater than 50% of my implied volatility range. But it's important when you're looking at that percentile to look at the actual numbers, because this may not be as wide as a range, true range, as you think it is. All right. So that's basically what I wanted to cover. Again, questions, go ahead and send those in. I just wanted to remind everyone, of course, about the PowerOptions services. If you have not done so yet, go to PowerOp.com and sign up for your 14-day free trial. You just need a first name, last name, and email address. The 20-minute delayed service gives you access to all the tools and all 23 different strategies. With 20-minute delayed quotes, it's only $60 per month. You can also upgrade to the 20-minute delayed plus historical. So for the backtesting tools, it's $40 more. So it would be $100 per month for the 20-minute delayed plus the historical. We do also offer a real-time service. So every time you refresh the page or run a new search, you're getting the numbers at that instant, and that's $100 per month. And then, of course, the full service, the real-time plus historical, and access to the API would be $140 per month. Of course, we offer discounts for annual subscriptions as well. Well, I want to thank you for joining me today. I hope you all got some useful information out of the implied volatility and our views on using implied volatility for your options investing. If you have any other questions later on, just go ahead and send me an email at any time to support@powerop.com. And you can also call us during market hours. You can reach us at 302-992-7971. There's also contact links at the bottom of every page. Okay. Oh, okay. Ron, I'm sorry, R asked, it's R, yeah, R asked, what if you wanted the radioactive trade, the fusion subscription, and 20-minute delayed? Well, they're two separate services. We don't have a combined service right now that includes fusion and PowerOptions. So PowerOptions would still be $60 per month, and then the fusion subscription at radioactive trading is $69 per month. So you'd be paying two separate fees for those two separate subscriptions. So with 20-minute delayed and the radioactive trading service, you'd probably be paying, it would be $129 a month to follow the trades on Fusion and the other lessons, plus use PowerOptions with the 20-minute delayed service for running your own screens and researching and analyzing your own positions as well. Those are two separate services. They're not, we don't have a combined service that includes both right now. Okay. Well, thank you again, ladies and gentlemen, for joining me. I think that's all the questions that we had that came in at the end. Look for this webinar again. It'll be archived later on, hopefully this afternoon or first thing tomorrow morning. And again, to access archives, underneath the main home tab, just click on Learning Center. From the Learning Center, click on Webinars. And you see here the upcoming live webinars. You can register for those on the left, and our archives are organized by category on the right. And let's go ahead and click on Options Strategies. This is where it'll be located. In our first Options Investing Concepts, Greeks and Why You May Not Need Them from last week is already archived there for you. And this one, the Implied Volatility, the Double-Edged Sword, will be listed there as well later on this afternoon or first thing tomorrow morning. Well, thank you again, ladies and gentlemen. I hope you all have a fantastic week, and I hope to see you at one of our upcoming webinars soon, maybe Friday's open discussion, open forum presentation, and we'll have another investing concept series presentation next Wednesday at 12 noon as well. All right, take care, everyone. Good night.